Hello and welcome to another edition of the video market update. Okay, what we have in take one. Take one. Welcome to another edition of the video market update. And if you listen to the podcast, we spoke about some critical levels on the various charts of the stock indices. And what we have in front of us is the S&P 500. And remember, the reason why we look at charts is that charts tell us what is going on in the markets and can give you further insight into the behavior of prices. Okay, so what we have is that the S&P 500 going back has been in a broader bull market. A series of higher highs and higher lows make up a bull market. Higher highs, higher lows. Okay, the market came up, made a new high, and what could be happening, or what we see, is that why this 1900 level is critical support in the markets is that this is a previous low that, if broken, would break the series of higher highs and higher lows, and that would be the first indication that the market could be in some trouble. So we're going to this level right here. We closed just on it on Friday, so we're going to see if the market is able to hold above this level. If it closes below the 1900 level, the next area of support is at 1820 and 1740. If these areas are broken, we will definitely start to enter bear market territory, and you could see a pattern of lower lows and lower highs, which would be just the opposite of higher highs and higher lows. So for the coming week, we will definitely keep an eye out on this 1900 level. And looking at the Dow Jones Industrial Average, as we said on the broadcast, that this chart looks a bit more favorable because the distance to the low here, from this low to here, is larger. So this market doesn't look like it will take out the low immediately. Right here, and this low is at about 16,330 or so. And just similar to the S&P 500, we have a series of higher highs, higher lows, and what this could do is break that series of higher highs, higher lows if the market does close below that 16,300 level. And one of the things we do keep an eye on prices also is that when you break certain levels on a chart, you have a lot of technical and automated trading systems that come in and sell the market. So that's one of the reasons why we keep an eye on the prices also. Looking at the Nasdaq, and we said the Nasdaq was the best performing index out of the 5 or 6 we looked at in the podcast. We see that from the low that was made, this is the monthly chart of the Nasdaq index. From the low that was made in 2009, here just above 1,000, market peaked at 4,000. But as you can see, market still has not gotten above the previous high that was made in the dot-com bubble of the year 2000. The market still hasn't breached this high. So that just goes to show you how far the market fell from the dot-com bubble. It was such a huge sell-off. Okay, so similarly now the chart on the Nasdaq looks a bit better than the S&P 500, but not as good as the Dow because it's a bit further away from the low. But we closed just above the low of this low point here is 38.49, and the market closed at 38.70. What would be interesting is to see if next week, if all three of them hold above these very critical lows. If we see all three of them close below these lows, that would be very bad for the markets, for the technical picture of the markets. And well, we'll get into the other indices that we spoke about. The first one I spoke about on the podcast, and if you didn't listen to the podcast, I encourage you to go and listen to it. On the website, you will see podcast, smartinvestorcentral.com, and you will see podcasts, and you will see the latest episode of the podcast. We spoke about these indices, and we also spoke about exit strategies. Okay, so the first market we looked at was the FTSE over in London. And what we spoke about was the fact that this was the high that was made in 2000. This was a high in 2007, 2008. And this was the high that was made currently. As you can see, the market has not closed above these highs, which is very troubling for the market. Also, the low was at 3,500 and the high is just below 7,000. So the market has recovered 98% off of the lows. The market is up 98% off the lows of 2009. In contrast, S&P 500 is up over 200%. So that's what we're pointing out in the podcast, that the recovery here in the FTSE has been relatively weak compared to the other world indices. And let me just take a daily look at the FTSE here. We see that the market has broken below very critical areas of support. These areas of support, which gives me caution. And if I was in this market, I definitely would have sold my position already. Okay, moving on quickly we took a look at the German DAX. Again, this market is in an uptrend, but the recovery wasn't as strong off of the 2009 lows as the US S&P 500. And curiously, the market failed to, on this attempt at a rally, the market failed to eclipse this previous high and has broken below very critical support at 9,000. So the question is, are the world markets leading the S&P 500? And is it a leading indicator to say that the S&P 500 could fall further? We will just have to wait and see. But this is a very bearish pattern for the FTSE, for the DAX, sorry. And if I was in a position, I would be out based on this daily chart. Okay. Taking a look at the Nikkei. Okay, the Nikkei 225. On the podcast, we mentioned the fact that the peak in the Nikkei was in 1990, where the market climbed to over just below 40,000. This was the high, and as you can see, the market has never recovered since then up to that point, and it's at 14,000. So if you were in the Nikkei and you bought somewhere near the peak, which most people actually do because they buy when everything is euphoric. If you bought somewhere up here over the last 2 decades, throughout the 90s and the 2000, 2010, 2014, over the last 24 years, you would still be down over 50% if you bought near the highs. So this idea of buying and holding in the stock market can be very dangerous. And sometimes bull markets can end, and some folks are fearing that for the S&P 500 now, that the bull market will end and you will never see new highs again for another 10, 20, 30 years, which would be very devastating for investors that are not diversified. Because if you are diversified into other assets that are performing, you wouldn't worry much about this situation. Okay, the final market we took a look at was Australian dollar stock index. And we see this market is also very bearish, but the critical support here is at down at the 5,050 level. If the market closes below 5,050, that will be extremely bearish for this market. And just in comparison, off of the 2009 lows, the market is up I believe about from 3,500 to 5,500. Not very good. I think it's over 60% off of the lows. So this market this Australian stock index hasn't done very well. Okay, so moving on, the other market we took a look at was the dollar. And what happened was the dollar, this is a chart of the US dollar index, and the US dollar index broke out of a consolidation pattern. Broke out of a consolidation pattern and tested the breakout point near this trend line. And this market is still in an uptrend currently. It's very, very positive. As you can see from the dollar index here, the low that was made in the dollar was in 2008, I believe it was February of 2008, and the market has not gone below that point ever since. Hasn't really rallied that much also, but it has been holding up fairly well. And finally, the gold market. We see that the market has been in a broad downtrend ever since the high was made in July of 2011. And this is another reason why we look at price charts, because if rule number one of investing is don't invest in assets that are in downtrends. And this is in a clear downtrend. We have a series of lower highs, lower lows on the daily chart. Now at some point gold may turn around and we break out of this consolidation pattern, and then we could get higher highs, higher lows. But the point is that hasn't happened as yet. So really the thing is, we have been on the short side of this market. But curiously, this week we tested this previous low. As you see, in June 2013, the market made a low of just about 1180. Again, in January 2014, the market made another low. And now this week here in October, the middle of October, the market made another low and tested this low and is successfully testing it so far. So should you go out and buy this market, I would wait until the market goes into an uptrend, because what we could see is that the market could come up and then recover down. But we could be seeing the low in gold, who knows? But I would look for further evidence of strength before I enter this market. Okay, I hope you enjoyed this video presentation. I encourage you to come and visit me on the webinar where we're hosting a live investor workshop where we will discuss our investment philosophy and how that can assist you and help you become a better investor. Remember, the point is not to turn you into an expert trader, but to become a more informed investor. So this is Beyond. I hope you join me on the webinar. For webinar information, you can go to smartinvestorcentral.com/webinar and sign up for the next available date. Thank you very much for listening and have a good day.